Good day, everyone. Welcome to the second installment of the Brewing Finance Conversation on Bond and Sukuk podcast series. My name is Jack, and I'm from the Securities Commission Malaysia, SC. Today, we are diving into the current hot topic of sustainability in Malaysia's bond and sukuk market. Joining us is Mr. Leslie Jong, a leading expert in ESG and sustainability for MARC Solutions Sdn Bhd. Welcome, Leslie. Before we begin, could you tell us a bit about yourself and what do you do in MARC?
Thanks, Jack, and thanks, SC, for inviting me here. My name is Leslie, and I oversee and lead the sustainability initiatives in MARC. So this includes all the ratings and also all the advisory work. So we're also trying to go into different projects for the time being. Yeah.
All right. Thank you for introducing yourself. Now, let's dive into our first segment, where we'll explore current trends in the bond market with a focus of sustainability in Malaysia. This topic has gained significant attention as more investors seek to align their investments with ESG criteria. So, Leslie, what are the current trends in the bond market regarding sustainability in Malaysia?
To put it simply, there has been a steady and progressive growth in the sustainable bond market in Malaysia and in the ASEAN region. As of 2022, sustainable bonds make up to about 2% of the total local corporate bond share. The largest sustainable bond share is contributed by financial institutions, followed by industry players from the real estate, energy, and utility sector. Based on Capital Markets Malaysia's database, a total of 10.58 billion ringgit of SRI Sukuk was issued in 2022, bringing the cumulative amount of SRI Sukuk issued under the SRI framework to RM 18.92 billion since its inception in 2014. Some 16.58 billion ringgit of these issuances were recognized under both the SRI Sukuk framework and the ASEAN Sustainability Bond Standards. It is also noteworthy to highlight that the issuance from Malaysia made up to about 24% of the total issuances under the ASEAN standards.
What about the demand? How do you see the demand for sustainable bonds changing in the near future, particularly in light of global trends?
It's all about moving with the times. Wind the clock back 10 years ago, green and social bonds are seen as revolutionary financing instruments, and demand for such bonds are still relatively low due to them being in their infancy. Fast forward to the present, we can see that the demand for sustainable bonds is ever growing, as both investors and issuers are looking at more complex and diversified offerings considering the evolving sustainability landscape. Ultimately, the demand for sustainable bonds is driven by emerging technologies such as green hydrogen, biofuels, carbon capture, utilization, and storage. The sectors with the highest growth potential for sustainable bond issuance and investments in Malaysia are the renewable energy, energy efficiency, water and waste management sectors. In fact, a significant portion of investor portfolio in the Malaysian green bond market are already comprising of investments in these sectors. Also, in light of the changing sustainability conditions, there will be an increased focus on transition finance in the near future as both issuers and investors gears towards their decarbonization and net zero aspirations.
Can you explain about the role of the rating agency in the bond market, particularly in relation to ESG bonds?
Okay. Generally, rating agencies evaluate the bonds at the time they are being issued. So bond ratings are crucial as they dictate the rates that investors pay on these issued bonds. Essentially, rating agencies provide independent opinions on the credit risks and potential default risks of each specific bond issuer to provide the much-needed transparency in the bond market. In the sustainable bond market, a rating agency such as MARC functions as a second-party opinion provider. A second-party opinion is an assessment that is independent of the issuer, which reviews alignment of the issuer's bond of their financing framework against the core components of the green bond principles. They are usually commissioned by the bond issuer, and a rating agency will then assess the sustainability credentials and the issuance framework of the proposed bond. To add further granularity, the assessment of an issuer's green and social credentials is essentially an evaluation of the environmental and social impacts of their EMARC-eligible projects, or KPIs and SPTs. An SPO also assesses the issuer's ability to manage and mitigate environmental, social, and governance risks effectively. All of these qualitative and quantitative aspects of the SPO are pivotal, as the SPO ultimately helps investors in making informed decisions on their investments into the corresponding sustainable financing instruments.
Moving on to our next segment, let us discuss the acceptance and assessment of SRI Link Sukuk. This is a relatively new area. In 2022, the SE launched the SRI Link Sukuk framework to facilitate fundraising to enable companies to transition into a low-carbon or net-zero entity. Unlike SRI Sukuk, there is no restriction on the use of proceeds. For the issuers of SRI Link Sukuk, the proceeds may be used for general purposes, offering flexibility to issuers and encourage greater mobilization towards sustainable development, whereas the proceeds from SRI Sukuk must only be used for funding of eligible SRI projects. It will be interesting to hear from your perspective, coming from a rating agency. What is the level of acceptance from issuers and investors towards SRI Link Sukuk? And are there any notable differences between their acceptance of SRI Sukuk and SRI Link Sukuk?
Okay. SRI Link Sukuk contributes to a small share of the sustainable bond market in Malaysia. While current data is not available in Malaysia, globally, SLBs make up to about 6% of the total sustainable bond market as of January 2024. From MARC's perspective, out of the nearly 30 SPOs that we have completed so far, only 2 of these SPOs have been aligned with sustainability link or SRI link requirements. It is safe to say that the level of acceptance thus far is heavily skewed towards the way of SRI Sukuk issuances. The main reason why issuers have shied away from SRI link issuances is because of the apprehension involved in developing and fulfilling their KPIs and sustainability objectives. Generally, issuers find conventional sustainable bonds more accessible despite the proceeds from the bonds being ring-fenced. However, we have over the past 6 months noticed an uptake of SRI Link Sukuk, as more and more issuers are beginning to embrace the dynamics of SRI Link issuances. There is this gradual realization from issuers and investors that conventional sustainable bonds alone will not be enough to achieve net zero aspirations. While sustainability-linked bonds in their current form are not revolutionizing the corporate debt markets, with a few meaningful reforms, this instrument could potentially move the needle in one of the most overlooked forms of capital that can drive emission reductions.
What about the creditworthiness? How does your agency assess the creditworthiness of issuers of sustainability-linked bonds?
Much like conventional bonds, MARC utilizes an established set of methodologies that forms the basis of our ratings of sustainability-linked bonds. For non-financial issuers, MARC's analytical framework consists of 4 qualitative and quantitative areas, namely financial risk, business risk, management and organizational structure, and other pertinent considerations. MARC's analysis of financial risk mainly revolves around profitability, cash flow adequacy, capital structures, and financial liquidity. Business risk takes into account industry structure and business environment, market position, diversification, and operating efficiency. Next, analysis of management and organizational structure considers management track record and the issuer's risk and control management framework. And lastly, the analysis of other considerations includes issue structure and terms, parent subsidiary linkage, country ceiling considerations, and any other relevant government support. For financial institutions, MARC's rating approach is modeled after the CAMELS rating system, where an issuer's capital adequacy, asset quality, management, liquidity, and sensitivity are all considered. Each of these considerations collectively forms MARC's basis for an issuer's long-term or short-term ratings. The SPO portion of the sustainability-linked bonds assessment will be conducted using MARC's impact bond assessment methodology. Our IBA methodology consists of 3 main segments. In the first part, our impact significance analysis will assess the materiality and scope of the proposed KPIs and SPTs. Thereafter, we will conduct an evaluation of compliance with the SLB principles. This will include selection of KPIs, calibration of SPTs, the bond characteristics, reporting and verification of data. Lastly, our IBA will also consider the sustainability performance of the issuer on an enterprise level.
Alright, moving on to our third segment for our podcast series. In this segment, let us take a closer look at the market infrastructure in Malaysia and how it supports the development and issuance of SRI Sukuk and bonds. Malaysia has a well-developed bond market infrastructure that supports the issuance of SRI instruments. The SC provides clear guidelines and frameworks for green and sustainable finance, including the SRI Sukuk framework. There are also various tax incentives for issuers, such as the tax deductions for the cost of issuing green Sukuk. Even profit paid in respect of Sukuk is exempted from income tax. In terms of listing, issuers can list their Sukuk on ETBS, which is an exchange specifically for bonds and Sukuk under Bursa Malaysia for retail investors to gain access. All right, Leslie. How does the current market infrastructure in Malaysia support the development and issuance of SRI Sukuk and SRI Link Sukuk?
We have come a long way since SC's establishment of the Sustainable and Responsible Investment Sukuk framework back in 2014. The introduction of this framework has facilitated the creation of an ecosystem that promotes sustainable and responsible investing for SRI investors and issuers. This framework was further expanded in 2022 to accommodate SRI Link Sukuk issuances, heralding a new era in facilitating fundraising that addresses pertinent sustainability concerns such as climate change. SC's establishment of the SRI Sukuk Bond Grant Scheme in 2018 has also solidified ongoing efforts to encourage further adoption of sustainable financing in the Malaysian debt capital markets. This scheme covers up to 90% of the second-party opinion or external review costs incurred by the issuer on sustainable Sukuk issuances. Coverage of this grant is extended for issuance under SC's SRI Sukuk framework and bonds issued in Malaysia under the ASEAN Green Social and Sustainability Bond Standards. In 2022, this grant scheme was further expanded to include SRI Link issuances under SC's SRI Link framework, rendering SRI Link Sukuk holders being also eligible for the same benefits compared to SRI Sukuk issuers. In addition, tax deductions are also applicable to issuance expenditures for all types of bond and Sukuk that achieve green, social, and sustainable standards in Malaysia as approved by the SC. I believe that the SC is also currently working with the JC3 in conceptualizing a transition finance framework to guide credible transition financing solutions. We and MARC are really looking forward to this development.
What more can be done to further facilitate the growth of sustainable finance in Malaysia? In your opinion, are there any specific innovations that you think will be particularly effective?
There is a lot that needs to be done in order to facilitate the growth of sustainable finance in Malaysia. And these efforts requires a multi-pronged approach and considerations from the financial sector, regulators, and industry players. From a financial perspective, investment banks being the intermediary between issuers and investors can play a heightened role in increasing of awareness and accessibility of sustainable finance. Investment bank activities can significantly influence the success of bond offerings, ranging from pricing to the underwriting and the distribution of the bonds. Instead of just an advisory role, investment banks can also assume an advocacy role to ensure the growth of the sustainable finance landscape in Malaysia. From a regulatory perspective, the harmonization between local and international standards or best practices can immensely facilitate international capital flow. Issuers stand to benefit from clearly defined parameters for issuing sustainable bonds, as well common metrics and definitions to determine which projects are environmentally and socially sustainable. And finally, from MARC's perspective, a rating agency should offer comprehensive public information about the criteria and assessment process undertaken to provide a second-party opinion for the issuance of a sustainable bond or Sukuk. As more standards and guidelines materialize in an emerging market, there is also an impending need to regularly review and update our respective assessment methodologies to cater for a wider range of sustainable finance offerings. As for innovations, a particularly interesting and effective one would be Bursa Malaysia's centralized sustainability intelligence that enables ESG reporting. The centralized sustainability intelligence provides robust Scope 3 insights and connects corporates and their supply chains to specially curated financial incentive programs through partnerships with financial institutions.
Are there have been any countries that have been successful in providing greater market infrastructure? What did you do differently, and how did they manage to reach this level?
There are quite a few examples of greater market infrastructures available in foreign countries, with a prime example being the EU with the European Green Bond Unified Standard. However, we don't really have to look far, as our neighbours have provided us with an example of a developed market infrastructure that designed to support and enhance a sustainable finance ecosystem. Just recently, Singapore launched a taxonomy to define green and transition activities across sectors with their Singapore Asia Taxonomy for Sustainable Finance. This taxonomy aims to reduce the risk of green or transition washing, and it also covers 8 focus sectors, each with their own technical screening criteria. Another important feature of this taxonomy is the introduction of a transition category, which utilizes a traffic light system aimed at enabling users to clearly distinguish between eligible and ineligible transition activities. Lastly, this taxonomy also incorporates a measures-based approach aimed at facilitating sustainable transition by encouraging decarbonization measures that support emission intensity reductions. All of these parameters provide issuers and investors a guidance on defining green and transition activities, enabling identification and allocation of capital to sustainable projects and initiatives.
Now, let us summarize some key points from our discussion earlier on. The main takeaway is that SRI bonds and Sukuk are not just niche, but are becoming mainstream. What are the key takeaways for our listeners about the role of SRI in the Sukuk and bond market?
I think what we have discussed so far can be summarized into four main takeaway points. First of all, the SRI frameworks enables issuers the flexibility and dexterity to raise funds while addressing pertinent sustainability concerns such as climate change and the broader social agenda. Consequently, this also enables investors to align their financial goals with a broader sustainability oversight. Secondly, the SRI bond and Sukuk market is growing and is definitely here to stay. This represents an avenue for both issuers and investors to capitalize on both for their financial goals and sustainability agendas. Moving on, while there are benefits tied to the issuance and investments of SRI Sukuk and bonds, the underlying concerns pertaining to these instruments cannot be overlooked. This includes concerns whether the funds raised will be translated to actual sustainability impacts. Lastly, the regulators, issuers, and the market are working cohesively to address all of these underlying concerns. This includes the refinement and development of more robust standards and taxonomies for greater adoption, and the role of rating agencies such as MARC as second-party opinion providers.
Why should investors, particularly retail investors, should consider prioritizing SRI? How would this benefit their investment portfolio?
SRI provides an avenue for investors to diversify their investment portfolio while keeping an eye on their overarching sustainability agenda. In essence, investors can align their investments with their own intrinsic values, such as investing into green projects that they believe will bring betterment for future generations, or investments in conservation projects to offset their carbon footprint. From a financial perspective, investments in SRI bonds and Sukuk also improves the potential for long-term returns and risk-adjusted returns. Companies with strong ESG practices are generally better equipped for future challenges and may have better long-term prospects for their overall perpetuity. Putting the pieces together, SRI investments offer portfolio diversification with a reduced overall portfolio risk while contributing to a more positive societal impact.
We are now towards our final segment for our podcast. We will now focus on future development. So, Leslie, what upcoming trends or innovations in the sustainability bonds and Sukuk market that you are most excited about?
From our perspective, the upcoming trend that excites us the most is the advent and the gradual adoption of transition bonds and financing. Transition finance provides an avenue for issuers from the hard-to-abate sectors to decarbonize high-emitting physical assets, and government and banks across Asia are starting to use transition bonds to engage further investments and to implement decarbonization initiatives at scale. Transition finance could potentially address the gaps in conventional sustainable bonds, considering the proceeds from sustainable bonds are ring-fenced and the lack of KPI materiality of some of the sustainability-linked bonds. Another innovation which we are keenly anticipating will be the development and enrichment of our taxonomies. Considering the taxonomies that are currently in place, such as the SRI frameworks, those that are new to the market, such as the climate bonds taxonomy from the Climate Bonds Initiative, and others that are in the pipeline, such as SC's and JC3's Transition Finance Framework. The further development of taxonomies will be one of the catalysts for future growth of the sustainable finance landscape. This, in turn, will help us to ensure that issuers uphold stringent standards and that capital is being channeled towards credible projects that will help with their transition.
Looking ahead, what are the biggest challenges and opportunities for growth of sustainability and sustainability-linked bonds and Sukuk in Malaysia?
Again, from our perspective, there are quite a few challenges that affects the sustainable bond and Sukuk market in Malaysia. The most pressing of these challenges would be the lack of robust ESG data and tracking processes, which hinders transparent and meaningful discourse of impact of the underlying bond. This is especially prevalent for sustainability-linked and climate bond issuers. Another challenge being faced by sustainability-linked bond market is the insufficient ambition and materiality when developing sustainability performance targets. As mentioned earlier, the apprehension involved when developing these metrics can be attributed to issuers lacking the capacity to fulfill their bond indicative obligations. Examples of this would be an issuer's GHG targets being misaligned with SBTi recommendations, or simply picking immaterial KPIs as a means of just issuing the bonds. There is also a strategic inconsistency which could ultimately lead to the mismanagement of broader sustainability risk. This could occur when an issuer lacks the broader sustainability strategy accompanying a sustainable issuance, and there is a clear inconsistency between what the issuer does beyond their intended sustainability parameters. Despite these mounting challenges, we are beginning to embrace opportunities as the sustainable bond and sukuk market matures. With the enhanced disclosure requirements and reporting standardization put in place by Bursa on Malaysia's corporates, issuers can significantly reduce their time and cost in setting up a sustainable bond program, particularly if they are already disclosing relevant data points as part of their existing reporting obligations. In line with this enhanced disclosure requirement, the refinement of corporate sustainability strategies also helps to address strategic inconsistencies. It also helps issuers align the objective of their bond issuance with their overarching long-term sustainability goals.
So how can the industry overcome these challenges to ensure a robust and vibrant sustainability bond market?
This is quite a tricky subject matter as it involves a holistic approach from all parties, ranging from the regulators to the industry players. Essentially, both market best practice and regulations have a role to play in addressing the integrity concerns and greenwashing risk in sustainable finance. The main onus lies with the issuer to focus on meeting acceptable industry best practices. This includes aligning their issuances with taxonomies and their broader sustainability objectives, setting sufficiently ambitious sustainability targets and objectives in relation to specific issuances like the SLBs, and the willingness to seek external verification on compliance and post-issuance impact reporting. The industry should also help improve the availability of ESG data and analysis, which requires a collaborative effort from the top down. Bursa Malaysia has done a fantastic job with the enhanced listing requirements of sustainability reporting, which takes into consideration the correlation between a company's common sustainability matters and their corresponding financial figures. Additionally, to mitigate any risks associated with sustainable financing, regulatory oversight should also be tightened to prevent any instances of greenwashing and misappropriation of proceeds. Consolidating all pertinent and available frameworks into one harmonized framework will also go a long way in streamlining the adoption of sustainability bonds in the market. Last and certainly not least, we should continue to leverage on the market best practices for the sustainable finance market contributed by regulators and policymakers. While sustainable financing frameworks and taxonomies are continuously being refined and worked on, the onus lies with us to capitalize and make full use of it.
That wraps up for our discussion for today, Leslie. Thank you for sharing your insights on the SRI bond and sukuk market in Malaysia with us. It has been a fascinating discussion.
Thank you, Jack, and thank you to the SC again for inviting me here.
And thank you to our listeners for tuning in. Stay tuned for more episodes on Brewing Finance Conversation and on Bond and Sukuk.